Okay, so today we are unpacking the architectural blueprint of what might honestly be one of the most massive corporate turnarounds in recent history. We're talking about Opendoor, but, and this is crucial, not the company you might remember from a few years ago. In this explainer, we're going to look at the systematic dismantling of a really fragile system and how they rapidly built a lean, nationwide powerhouse in its place. Let's call it Opendoor 2.0. We're basically going to read this blueprint from the foundation up. Here is our master blueprint for today's breakdown. We'll hit 1. The iBuyer crash. 2. Dismantling old Opendoor. 3. The nationwide blueprint. 4. Fixing the financial gears. And finally, 5. Making macro irrelevant. Let's dive right in. Starting with part 1, the iBuyer crash and understanding those old flaws. Listen, the consensus on Wall Street right now is still largely anchored to a dead model. The old version of this company operated in roughly 50 metro markets and carried some incredibly fragile, high-spread debt on their balance sheet. But you know what the fatal architectural flaw really was? Their whole business model was structurally dependent on rising home prices. If their pricing algorithm made a mistake, home price appreciation would basically bail them out. But, what happens when prices actually stop rising? Well, we all saw that brutal reality play out in 2022 and 2023, right? iBuyer market share peaked and then just absolutely crashed under macro stress. Mortgage rates doubled, buyers completely vanished, inventory just sat there collecting dust, and spreads went negative. The old model was obliterated. Giants like Zillow and Redfin threw in the towel and entirely exited the iBuying space. Opendoor's stock fell 99%, and most of the market completely wrote them off as terminally broken. But what people missed was that in all that rubble, the foundation for something vastly superior was actually waiting. Which brings us to part 2, dismantling old Opendoor and the structural reset. Enter CEO Kaz Nejatian. He takes the helm and kicks off this wildly aggressive teardown of the old framework in under 6 months. They systematically dismantled every core weakness of that fragile old model. They took coverage from 50 up to over 380 metropolitan statistical areas. They slashed their fixed operating costs by 20 to 30%. And most importantly, they built a model specifically designed to generate positive contribution margins, even when housing prices are totally stressed out. Now, the crucial first step here was fixing the balance sheet. Back in 2025, Opendoor reported a $1.1 billion GAAP net loss, which understandably spooked a lot of people. But if you actually dig into the filings, about 85% of that was just a non-cash accounting charge from a deliberate debt restructuring. They raised equity above today's stock price and wiped out a massive amount of principal. The result? Their debt-to-equity ratio fell from a super fragile 2.20 down to a remarkably stable 1.31, all in a single quarter. Basically, the balance sheet is now built for growth, not just, hanging on for survival.
All right, part 3, the nationwide blueprint and their rapid scale.
Picture this in your head, 50 isolated dots on a map. That was a whole decade, of slow market-by-market expansion under the old management. Then, practically overnight, those explode into over 380 interconnected dots. That is a 7 to 8 times expansion of their addressable seller supply. They can now make offers in substantially all residential zip codes across the contiguous U.S. It's huge. And the sheer speed of how they pulled this off is staggering. We're calling these the 10-week sprints. Nejatian comes from Shopify. He was their COO, so the guy clearly values velocity. In his very first 10 weeks, they nailed that nationwide expansion. Just think about that for a second. What took the prior guys a decade to do for just a third of the market, this new team did in 10 weeks. And the next 10 weeks, a tiny team of exactly 4 engineers built a 4.99% mortgage product from scratch. This isn't just a real estate company anymore, folks. This is a high-velocity tech company.
Moving on to part 4, fixing the financial gears. Getting stripped down to the studs. Because they really did strip this house right down to the studs. Like we mentioned, fixed operating expenses got chopped by 20 to 30% year over year. Tech infrastructure and hosting costs, those plummeted from a $12 million annual run rate down to under $5 million. But you want to know the most vital gear in this whole machine? It's aged inventory. Homes that have been sitting on the market for over 120 days dropped from 51% of their book down to just 10%. They are churning inventory incredibly fast now. And because fixed costs are so low, as their transaction volume scales back up, the profit is going to flow disproportionately straight to the bottom line. That is pure structural operating leverage in action. And if you want foundational proof that these new gears are actually working, here it is. At their Q1 2026 open house, the headline literally read, "October was just the start."
Their October 2025 cohort, which was the first full month running under this new 2.0 model, generated the highest contribution margins of any October cohort in the entire history of the company. More than half of those homes were sold or under contract in under 5 months. But here's the absolute kicker. They hit their best ever margins while national home prices actually softened by about 300 basis points. The new model didn't just survive price stress, it thrived right in the middle of it.
Oh, and remember that 4.99% mortgage I mentioned, the one built by 4 engineers? That is essentially a second, super high margin business hiding inside the first one. By automating the underwriting process, they were able to strip 65 to 85 basis points of yield right away from traditional middlemen. That lets them offer a mortgage rate practically a full percentage point below the market average. It speeds up how fast they can sell homes, it spits out high margin origination fees, and honestly, it turns elevated interest rates, which has been the biggest macro headwind for the last 3 years, into a massive competitive moat. Absolutely brilliant. All right, final section, part 5, making macro relevant and the math behind market share.
I want you to really lock in on this tiny, tiny number, 0.3%. What does that actually mean? Well, in 2025, Opendoor sold about 11,800 homes. But the total U.S. existing home sales market, that's roughly 4 million homes a year, meaning Opendoor has a whopping 0.3% market share. Now, the arithmetic here is just fascinating. Because their baseline is so incredibly tiny, Opendoor can grow their transaction volume 5 times, 10 times, even 20 times over, without a single additional buyer entering the broader U.S. housing market. Let that sink in for a second. They do not need the Fed to cut rates to zero. They don't need a massive housing boom. They just need to capture more share from sellers who are looking for certainty and speed. By just taking share, they make the whole broader housing macro cycle practically irrelevant to their growth.
So if we look at the verified acquisition data, the base case modeling for 2026 points to roughly $9.2 billion in revenue with a 4.5% contribution margin, bringing in a positive $279 million in adjusted EBIT. But the real price here, the ultimate payoff management is targeting, is hitting adjusted net income breakeven by the end of 2026 on a rolling 12-month basis. With these brand new mechanical gears humming and a true nationwide footprint, they actually have a totally clear, mathematically sound path to get there. And this all leads to a massive shift in how we need to view this company. There was a recent piece in Investor Place that nailed it. Opendoor is not just a house flipper. It's building an AI-powered platform. The best parallel here is actually Carvana. Think about it. Carvana had a 99% stock wipeout in 2022. Everyone wrote them off as just a doomed used car reseller. But under the hood, Carvana was actually this real-time pricing engine and logistics network that was constantly learning. Opendoor is on that exact same trajectory. Their automated valuation model is an AI engine that literally gets smarter with every single transaction. They're an autonomous real estate trader now, not your old school flipper.
So I'm going to leave you with this final kind of provocative thought. If the absolute darkest days of the housing market are truly behind us, what happens when Wall Street finally looks past those lagging financial statements and realizes that Opendoor 2.0 is already completely rebuilt, operating nationwide, generating real margin under stress, and fully skilled to capture massive market share? Hey, don't just take my word for it. They publish their weekly acquisition rates live. Go track the numbers yourself and watch this blueprint come to life in real time. Keep learning, and I'll catch you next time.